now my great pleasure to introduce Jim Furey, tonight's speaker, who founded the small cap strategy boutique called Furey Research Partners in 2008. The firm has twice been recognized by Institutional Investor as the #1 independent small companies research firm. The firm has over 100 institutional asset managers, including Pembroke Management, as clients, and has emerged as the premier source for small cap strategy and idea generation.
It's a bull market for stocks. We're up 100% since the bottom. I don't think that it's the end. Large cap US market bottomed at 666. I think normalized earnings are about $100 for the S&P. A lot of people said, I don't think we had a major bear market bottom because we didn't reach 5 or 6 times earnings. Actually, I think we did. I'm also bullish on stocks because I fundamentally believe that policymakers in the United States and indeed around the world are trying to create inflation. And fundamentally, low and rapidly rising inflation is very bullish for equities. Why? Because earnings follow inflation. One of my beliefs is that liquidity, and particularly the Fed, drives stock prices. True is that when the Fed is printing a lot of money, that money goes somewhere. And in an economy that is contracting, which is typically when the Fed decides to print a lot of money, traditionally goes into financial assets. Stocks go up, bonds go up, interest rates go down, and the Fed hopes to get people to act, to marginally take more risk because they don't get enough return in fixed income, et cetera. We are in, I think, the sweet spot of the Fed printing money because of the secular problems that we all know so well. So one of the points to take away is don't confuse a bull market with a bull economy. Oftentimes, the best economies don't provide the best stock markets. Doesn't mean the Fed's printed less money. The Fed is pushing the money out there. The rapidity with which the money moves around in the economy is slowed, but it's going into stocks and bonds. And it was going into bonds, but I think now we're in the first or second inning of it trying to go into equities. It has been a wonderful 20, 30-year run, 29-year run, since Paul Volcker took over the Fed and crushed inflation. Bull market for bonds. Possibly today we're seeing Bernanke launching the bull market for equities. But it's his intention, I believe, to get inflation going in order to provide a negative return for a lot of the current bonds. One of the reasons the Fed wants to create inflation is because in the United States, we've got a big problem with tax revenues at the state level, and the states can't print money. When I analyze markets and policymakers and what might happen in the future, because as Ian said, you can't anticipate, you can try to anticipate, but you're never going to anticipate anything or everything perfectly. California, Illinois, New York, New Jersey, many states have structural problems with their taxes. 40 to 50% of their tax revenues come from the top 1% of wage earners. And that 1% of wage earners that make the most money have a majority of their income from capital gains. I think the Fed wants stock prices to go up, equities to go up, so that we get some capital gains, we get some income growth, and we can start to fulfill some of the entitlement and other programs that we have promised. I'm not so positive on the dollar. I don't think the dollar is going to collapse. But if I'm sitting in Montreal and I'm thinking about the forward period, maybe the dollar continues to deteriorate modestly, and your returns have to make up for a little bit of that modest return, or for that modest decline. The dollar is immensely important, and what Bernanke thinks of the dollar is even more important. Bernanke, in his press conference last Wednesday, told us what he thought about the dollar very clearly. I don't think the dollar's weak. Well, that's news to a lot of people, particularly if you sit up in Montreal. What Bernanke believes is that the dollar has given up the risk premium positively that was put into the dollar as a result of the financial crisis and the flight to safety. What does that mean? That means as the dollar gets weaker, modestly, as long as it doesn't collapse, the Fed is not going to tighten in order to be able to get the dollar up. The other thing I want to talk about is forward positive marginal change. If we sat here in 2000, we were all going to be rich, retire early, and the world looked perfect. Over the course of the next decade, U.S. stocks returned their worst return to investors because there was marginal negative change when it came to government balance sheets in the state and federal level. Politicians made bad fiscal decisions. The U.S. competitiveness declined, and risk appetites, as there was a financial crisis, absolutely imploded. I believe that over the next decade, what we're going to see is forward positive marginal change on each of these things. I'm a believer still in American exceptionalism and that we are not structurally flawed south of your border. So I think over the next decade, we will see strong returns. We'll see our political house get in order. The dollar will eventually return to a higher level. And risk premiums, people's desire to own risky assets, is going to improve because we hit the mother of all rock bottoms in November of 08 and then again in March of 08. And virtually every asset allocation in the world was selling into that bottom. That's why it was such a dramatic bottom. What are our messages again? Don't fight the Fed. Stocks are going to do well, bonds less so. Maybe lose money, particularly if the Fed really has inflation start to take off. Earnings growth, it's going well. Valuations, not cheap, but cheap relative to bonds. And we think there's going to be a series of continuing positive marginal changes in the environment. So we're optimistic.